Want to know how you can gain access to capital to jumpstart your journey to entrepreneurial success? For entrepreneurs who are just starting out or those who have been in business for years, Minority Business Access is your podcast. Welcome to our show, where we will guide you in avoiding the pitfalls and thriving in your chosen business. Now, on to the show with your host, Solomon Ali.
Today, we're going to talk about how do you borrow money. We're going to try to keep it really simple and really easy. There's three different categories, I believe, in borrowing money. First, you have to identify what it is and what type of money you wish to borrow. Okay, so do you want investment money? Okay, do you want debt money? Okay, or do you want some type of hybrid? Okay, a hybrid would be a combination of debt and equity. All right. Now, the first, debt money, is a straight loan. That's when your company or you on behalf of your company as a guarantor is going to borrow the money on behalf of the corporation, and you and the corporation are going to be signing for it. Okay. The first thing that has to take place is if you have a corporation, okay, you're going to have to do your minutes and your resolutions. The resolutions giving you the authority to actually borrow the money as the officer of the company, which also is giving you the binding power. And it will state also within that resolution approximately how much you're looking to borrow and what are the general purposes of that money is being, why it's actually being borrowed. Okay. Next, the board of directors. The board of directors would have already voted on you being able to borrow this money. So again, let's start over. The board of directors would vote on you being able to borrow your money, okay? And then resolutions and minutes will be created. And then you take the resolution to you with the bank along with your certificate of incorporations and your articles. Some will have a certificate of incorporation. Some will have articles of incorporation with that resolution. And I would always take a summary of how much it is that you're looking to borrow and what your use of proceeds are going to be. So that's for the borrowing the money. Now, let's go a little bit more in detail. When I go to the bank, all right, I'm bringing all that information and I'm having a good old chat with them. And I may be looking to borrow money to expand the company. All right, I already know and have identified what the collateral is. Now, we're going to talk about something that's called cross-collateralization a little bit later. I don't do cross-collateralization, and I don't recommend that you do that neither. But I talk about, wow, I got this particular asset that I'm willing to put up, and I would like a carve out later in the future on this particular asset as I bring that debt ratio down as far as what I owe you. Okay. And so a lot of lenders would be accommodating to that. But of course, you got to keep in mind the lender's objective is to protect the bank the best that they possibly can with as much collateral as they possibly can. So what are we talking about? If you're looking to borrow I'm going to use a number of $1 million. If you're looking to borrow $1 million, right, and you only have $1 million of collateral, well, you're not going to get $1 million loan. If you're looking to borrow $1 million and you have $1 million of collateral and you have cash flow that doesn't show that you can support paying back 1.25%, and plus your historical numbers does not show or justify that, guess what? You're not getting a loan. Okay? So now, here's what it looks like. I want to borrow money. I have $1 million in assets that I can place as collateral. The bank is probably going to say, okay, we'll give you $250,000. Okay, so now I get $250,000. However, the bank is going to still be looking for me to be able to debt service 1.25% of that $250,000. Okay, they're also going to be looking at what? The last thing. Ensuring that my collateral is good, my cash flow is good, and the capacity to be able to assure basically servicing that debt. So that's what they're going to be looking for. They're going to look for the credit, Okay, making sure that you have good credit, both you and your business. Your business should have what's called a Dunn's number, a Dun and Bradstreet number. You should have a Paydex above 82. Some people say 81, but it should be actually above 82, 83 Paydex. You should have a personal credit score as signing off on the officer of the company of approximately 771 or above if you want the best possible interest rates and things of that nature. Now, if you have a lower credit score, it doesn't mean that you can't get it done. It just means that you're going to possibly pay a lot higher in interest rate. Okay, so that's on just straight out borrowing debt. That's how the mechanics of that would look. Now let's go to equity. Well, equity is going to work this way. We're going to have a board of directors meeting. We're going to vote that we're going to exchange some of our stock in exchange for equity. We're going to determine that dollar amount, and once we vote, we will create both the minutes and the resolutions determining that. Then we will create what's called a prospectus or an offering document. Okay, I'm going to use the word prospectus, and that's going to outline a summary of your business. It's about 70 pages to 105 pages. But it's going to outline the summary of your business, the marketing plan of your business, the business strategic strategy, the collateral, the use of proceeds, the management team, a forecast showing how far and how much money you're going to make over what period of time. It's going to show the return on investments, your KPIs, everything of that nature, your return on capital, and your net present value. So it's going to show the potential investor who's looking at that prospectus all that particular information. In addition to that, it's going to tell them about the business itself. So let's say if you're going to be selling widgets, it's going to give a narrative of why these widgets are so great and how these widgets actually compare to the other widgets that's actually in the industry today. Okay. So it's also going to look at comparisons of your competition. What is your competition actually doing out there in the marketplace? Now, when you have that prospectus and all that great information in that prospectus, then what you're going to do is go ahead and take it to different people and attempt to raise money. In some states, when you begin to raise money and after you get your first dollar in, you have anywhere from 3 to 15 days, depending on which state it is, to actually go register with that state the money to register your offering, okay, within that state. And normally it's after you receive the first dollar, it's anywhere between 3 days and 15 days to actually get that document actually registered. And so you want to make sure that you do that. From that point, you're able to continue to raise as much money as you possibly can, depending on the offering. Some people will do a 501, okay? Some will do a 506. Some will do a 504 or a 505. These are called Reg D offerings, okay? And allow you to raise a certain amount of money. All right. Don't ask me about the crowdfunding because I'm not proficient on the crowdfunding, able to tell you a lot about that. I'm only able to tell you about the things that I know about and the things that I've been doing. Okay. So, and as investors bring in the money and you receive the money, normally it's a good policy and idea. It's not required, however, to put that money actually into a escrow account before you start using the monies, okay? When you do that, it allows you to stay a little bit more disciplined, okay, for the use of proceeds to ensure that those monies are going where it's supposed to be going. All right. So that's how you're going to raise your equity money. Now, some people are going to say, well, where do I go? Well, of course, you're going to start off with your family and friends, people who know you, people who like you, people who believe in your business. Then you're going to probably branch out to, guess what? Your potential customers, your vendors, okay, your suppliers, those type of people who know your business, things of that nature, understand your business, and who may want to invest in it and think that it's a good idea. Most of you won't be ready to go to Wall Street and raise capital there most of the time, because at Wall Street we want to see companies that are doing at least 10 million with at least a 20% net. So you're doing 10 million, you're netting roughly about $2 million EBITDA. So most of you are not going to be there. But if you are, then it's possible that you can hire a brokerage company to actually do the offering and the raise for you, which will make your life a lot easier. Now, do be aware, when you go to a brokerage house, okay, to actually raise your capital, you're going to pay what we call the banking fees, underwriting fees, and things of that nature. Sometimes it's on the back end, sometimes it's a portion of that's on the front end. I think my first offering was, back in the 84, 85, and and 86, 87, and we had to pay almost about $600,000 up front. Okay, for them to actually sit back. And then we were told that it was a bad time, they wouldn't be able to raise the money, yada, 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 and we didn't get that money back. And so you can imagine, if money is tight, you really want to think about that 2 or 3 times before you go that route. So you have to have a lot of confidence and some discretionary cash if you're going to hire a company like a brokerage house to actually do the offering and go ahead and take you on the road show and to raise the money. Okay. A combination, a hybrid. Okay. Some call it a pike. It just depends on what you want to call it. We're looking now at debt. We're looking at warrants, which are preferred positions within companies' stock. A preferred position or preferred stock mean that you're basically a creditor. So if someone says, hey, do you want to purchase some preferred shares? At the end of the day, that's pretty much you're going to be a creditor. Okay. Now, the preferred shares could have a option or a warrant to it to where you're able to convert those preferred shares directly into equity. That's a really sweet thing if you're able to convert to equity, which would be to the common stock. So if you're able to convert to common stock, that means you're able to share within the marketplace. Okay. And especially really great if the company is public. If you're a private company, which most of you are, it won't be as sweet because, of course, most companies are going to take anywhere from 5 to 7 years to build it up to the point to where they're even ready to go public, and meeting the requirements are pretty stringent. Okay, it's a very taxing thing. Let me say this. There are approximately 4,000 companies that are publicly traded in the United States. Okay. There are roughly 13 black-owned managed companies in the United States. I, Solomon R.C. Ali, was an officer and a director of 3 of them. One was Universal Bioenergy, stock symbol was UBRG. One was Revolutionary Concepts, stock symbol REVO, and the other one was JMI Telecommunication, stock symbol JMIM. Again, their stock symbol was JMIM. Those companies are no longer trading today, but that tells you that I sat in a unique position. So I have an idea and a really good, I'm an authority on what I'm talking about in that sense. If nowhere else, at least within my own mind, okay? So that being said, we can look at now which way you want to go. If I was raising money for a brand new company, I'm going to try to go the route of debt. Okay. Debt means I'm going to give up the least amount of ownership. Basically, I'm giving up no ownership of my company. I'm just borrowing money with a promise to pay it back over time. Okay. And I'm going to try to get that in the most favorable terms and everything that I possibly can. So that's what I'm going to try to do. Okay. If I'm really excited about the idea, then what I'm going to look at is, okay, what do I want to borrow against? Okay. Am I borrowing against my accounts receivables? Or am I borrowing against, do I want to borrow against my inventory? Do I want to borrow against my contracts? Now, some will try to say contracts and accounts receivables are one and the same. Yes and no. Contracts are generated basically long term. Accounts receivables are typically you're showing that work has been done, and a company will buy that work that has been done, sign off on it, okay? And so that is short term, normally 30 days. But contracts that have, let's say, a 2-year, 3-year, 4-year contract, you're able to sell that off. And many times the banks will buy that or loan you money against that. I don't like it when the banks want to buy my contracts. I like to borrow against my contracts, because in most businesses, here's what we're trying to do. I am trying to make the spread between the line of credit that I have for my company and the profits that I'm making. Okay, so that's what you're trying to do in business. You're trying to get the largest amount of credit lines that you possibly can get, and you're trying to make the spread. So if I got a $300,000 credit line, I want to go out and make, let's say, $500,000 in gross profits, right, with a 20% net, right? So a 20% net, let's say, will give me $100,000. So now off of that $300,000, I was successful in making a gross of $500,000 in sales, but we netted $100,000. So that means that, oh, wow, I did really good. I was able to pay the $300,000 back. And at the end of the day, I made $100,000 profit. So one would do the math there and say, basically, I managed that line of credit extremely well and did extremely well with it. That's how you want to look at it, because when the creditors are looking at it, that's how they're looking at it. They're looking at, can you manage money? Can you manage the money? And do you know how to manage money? The other thing is, guys, let's think of it from the creditor standpoint for a moment. If I'm loaning you $250,000, why would I make that loan to you today? Well, it's simple. You put up $1 million of collateral for me, right? Even if you fail, I can have a fire sale and sell your asset off at $500,000. So I can still get my money back. I can still pay my attorneys and accountants and everything of that nature, and the people who had to collect the asset and all of that kind of stuff, and go out and sell the asset and make a little profit. Okay. That's why they do it, and you need to understand that. So now when they sell the asset to an end user that they just purchased for $500,000, they're able to sell that asset for, let's say, $750,000 to an end user. So now the end user is feeling good because he still have 25% equity or a margin in there. So he bought it for $750,000. So he's feeling great. That's how it works in the real world. You're not going to get 100% dollar for dollar. It doesn't work that way. Okay. So my numbers might be a little bit extreme for some of you. You may feel that way, but let me tell you, those numbers are pretty right on, okay? Because if they have to take that asset and sell it, they have to be able to sell it quickly in a fire sale, all right? And when we say fire sale, we're trying to get rid of that asset in less than 30 days. That's a fire sale, all right? So what else do you need to know? I'm going to need 3 years of historical numbers, 3 years of historical numbers on my business. Okay, so I'm going to need 3 years of financials. I need 3 years of tax returns. My financials will need to show a upward trend. In other words, that we're making more money, okay, year after year, and our profits are actually going up, and that we can debt service the amount of money we're looking to borrow. I'm also going to need 3 years of my personal financials and 3 years of my personal tax returns, okay? So in my personal tax returns, what they're looking for is to make sure that I was taking the money out for my salary, okay, and not creaming the company or whatever, but I was just actually taking the money out for my salary, and that it's being shown where I'm paying my taxes and things of that nature. And then they're also looking on my personal financials as well, what other assets you may have that's showing on your balance sheet, or what other streams of income that you may have that may be able to support paying that debt back. So let's repeat this portion right here. 3 years of personal tax returns, 3 years of business tax returns, 3 years of business financials that show a upward trend, and 3 years of personal financials. That's what you're going to need to show a banker to be able to borrow and get some debt money. Okay. The last thing within your package and your summary, okay, you're going to have to show him a summary, what the use of proceeds are, what the collateral is, things of that nature. All right. That'll be it for your debt. If we're doing equity, you're going to have to show a really great prospectus, a great business plan to mention all the things that I mentioned before. You're going to have to be very excited about what's going on, what the use of these proceeds are, so that people will want to basically buy your stock. Now, here's what I like to do. Okay, I kind of like to sandbag. All right, and what do I mean by that? Sandbag is, I might know that I have 20 contracts, okay, that's pending, but I might only talk about 15, 16, or 17 of the 20 contracts, okay? In other words, I may not talk about the ones that are iffy. I may leave them out. I may feel like I can get them done, so there's really going to be 20, but let's not talk about those, because if they don't happen, then you look bad. If they do happen, that's what I'm calling sandbagging. You look really good. You look like, oh, wow, you got it going on. So that's what I like to do. I like to kind of sort of sandbag. So if I got 20 contracts that I know I'm going to close, and 3 of them are kind of iffy, I'm not about to talk about those 3 guys. I'm only going to talk about the 17 contracts that I know for sure that we pretty much already have signed, and it makes sense, okay? The other thing, I'm not going to talk about no pie in the sky. I'm not going to talk about, oh, a hope and a dream to close this deal or to do this. I'm going to talk about and keep it to the facts. That's what you want to do. Let's keep it to the facts. We live in a time and an age right now, people can Google anything. So don't stretch the truth. Keep it to the facts. Keep it very personal. Keep it what your beliefs are and why your beliefs are that way. And what you want to do is inspire other people to see the same things that you see. Okay. So when I'm raising money, I'm going to go in hand with my prospectus. If I'm looking at and I have contracts, I'm going to be showing my contracts. I'm going to have a non-disclosure agreement so that the potential investor cannot talk about it, share that information, or anything of that nature. And then I'm going to start off with probably my accountants, CPAs, and attorneys to see if and who they know, along with my family members and things of that nature, to begin to raise my money. I am going to have my stock price priced at a certain price. Let's say it's going to be $5 a share. I may be offering them, if they do this right now today, I may be offering them shares at $4, okay, or $4.50, whatever the case may be. In other words, I'm offering them the stock at a slight discount to what my actual offering is going to be, but you also have to disclose that, okay? So within your document as well, you're going to disclose, remember, when you're a company that's raising public money, disclosure, 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 disclosure. Wait, did I say that? Disclosure, disclosure, disclosure. You want to tell the good, the bad, the ugly. Tell the bad, the good, the ugly. The good, the bad, the ugly. Tell it all, folks. The more you tell and the more you share, the safer you will be. You don't want someone to come back and say that they didn't know that. You don't want someone to come back, let's say if you're taking a salary of $500,000. You want them to know that. Let's say if you're hiring your wife, you want them to know that. If you're hiring a child or a sibling, you want them to know that. If you're getting a contract from a family member or from a very close friend, okay, you want them to know, hey, I am getting a contract from a family member. Or it could be the other way around. I'm giving a contract to a family member. Disclosure, disclosure, disclosure. Please always share that. The second thing I'm going to say is this. Don't make a move without an attorney. And make sure that he opines, okay, on the things that you're looking to do and that he basically says that it's okay. In other words, it's his butt on the line, or should be his butt on the line. You're still ultimately responsible, but you want to make sure that your attorney signs off and opines and tells you that, hey, yes, you can do this way, and this is how it's done. Don't go out there trying to be all creative and stuff because you're working with limited capital or resources. That's not going to work, okay? All that will do is get you in trouble, so don't do that. The other thing we're going to go is once you get your money, place it in an escrow. Have those monies go in escrow. Don't begin to start spending that money. And don't go say, oh, I'm spending it on, eating out. No, you can, but no, let's be clear. You told the people if you didn't discuss it and share it in that prospectus as a part of your use of proceeds, excuse me, don't go using that money in that way, okay? Only use that money for how you said you were going to use it within those use of proceeds. So be very clear and be very thoughtful of what you're planning to do. Now, something very simple. If you plan to buy a dog, okay, to watch your premises, make sure it's in the use of proceeds, and then you can buy the dog. But if you go buy a dog and it wasn't in your use of proceeds, then shareholders are going to feel some kind of way. So just be mindful. Disclosure. Tell people the truth right up front. It's better to tell them right up front than to have to backpedal and try to tell them later or explain it later when they may not be very sympathetic to what you're doing at that time. Okay. I hope everybody got that. There's a lot more I can actually say about that and what to do and how to actually do it, but I'm trying to, for time's sake, keep it short. I know I'm running out of time here. The other thing is hybrids. I call them hybrids because it's just easy to say. I know everybody who's got a lot of people to work around me who actually have a MBA. And so they like to sit back and say, boy, you make it sound so simple. I didn't learn it that way in school, but we all get to the end result. I was helping a young lady years ago, and she was in an MBA program, and she was kind of doing poorly. And then we actually, by me helping her, she ended up pulling out with a B, a little bit above a B, just under an A. And she would always say, we were working on net present value. If you don't know what net present value is, go look it up. And I could almost look at the numbers and tell what it would be, whether or not if it's a 0, what do you do? If it's a 1, what are you going to do? If it's a 3 or above, or if it's a negative number, what are you going to do? And I could almost look at it every single time and tell her what it was. And then she would say, well, okay, you do it the black way. And I said, well, I don't know what the black way is. I just know how to do it. And she would just laugh, and she would take about 15 minutes to write out the complete formula and everything of that nature. And by the time she's 2 minutes in the formula, I already knew what the answer was. So it's kind of like this. If it's a 1, I'm doing the deal. If it's a 0, I got to seriously think about that deal. If it's a negative number, I'm not doing that deal. I'm going to run like hell, okay? And that basically is some of the things that people in business school, that's what they learn. They learn, hey, what makes a deal, how much capital is it going to take? When is the returns on these capital going to take place? Okay. What is the cycles and things of that nature? Guys, that's critical stuff to know. But when you've been in business as long as I've been in business, if you don't have a freaking gut feeling for this stuff, then you better rely on the professionals around you. I think in one of the other podcasts I talked about, you better not be the smartest person in the room. That's trouble. You want people far, far smarter than you in the room, and you want that collaboration to take place to create that other mind, okay? And you want people who can dot those I's and cross those T's. Let me go back a little bit. Picking a board of directors is extremely important. Do not, people, go out and pick your mother, your brother, your next door neighbor, a good friend because you trust them. They have no expertise. Pick people who have a expertise, who understand what it is to run a company, the direction that the company needs to go in, okay, and the things that need to be done. Even if they come from different industries than what your industry is currently, okay? Again, do not pick mom, dad, brother, next door neighbor, or a friend to sit on your board just because you trust them and you know that they'll vote the way you want them to vote. That's a fast way to run a company right into the ground, is to have a bunch of people following each other like a dog chasing his tail, okay? You don't want to do that. Find people, seek them out who have ran a business, who understand a business, who understand the duties, the obligations, and the responsibility of sitting on the board. Okay, let me say this. When you take on shareholders as the owner, as the founder, that is no longer your company. That is no longer your company. It is the company of the shareholders. You may be one of those shareholders. You may even be the largest shareholder. So what? What I do for one, I have to do for all. I can't share certain information with one shareholder and not the other shareholder. What I do for one shareholder, I have to do for all. The board of directors have a fiduciary responsibility to govern the company, to protect both the shareholders and the creditors. Did you hear what I said? The board of directors have a duty and a fiduciary obligation, okay, to protect the shareholders and the creditors from you making dumb decisions or just running it like your personal pocketbook. So make sure you have a good, solid board of directors who understand that, who understand business, who understand accounting, who understand legal, who understand financing, and who understands operations or marketing, okay, or other different things that you may need. That is extremely important. I'm so sorry that I didn't mention that earlier, but get you a good, solid board of directors, okay. Don't hire an attorney just because he's the cheapest one you can find. You may have to pay a lot more for an attorney. You might not be able to afford it. Then save your money and get the right legal representation. Very critical. Get the right legal representation. Same with accounting. Don't just pick the person that you can afford or work with. Get the right accounting representation to make sure that your books and everything are going to be correct and they're going to be stellar, okay? Because that is your credibility. That is your reputation. You want to make sure these things are done correctly. Last, get you a strategic a strategic consultant who understands how to grow a business, how to finance a business, and that can let you know what the various challenges are going to be, and that can help you to work with your legal professionals and your accounting professionals. Okay, he at least has that understanding and that knowledge that you don't have, to ask the questions that you won't even know to ask to help keep you out of trouble. Okay, so make sure you get that strategic guy that will work with you and helping you with your legal counsel, working with your legal counsel, asking the right questions, making sure what you're looking to do is being shared with counsel correctly and properly, and the same with accounting personnel. Now, all that being said, now you're off and you're ready to go raise the money. Again, make sure you use the money under the use of proceeds the way you said. And remember, disclosure, disclosure, disclosure. Okay. On your hyper, it's a debt. Hey, I may not be able to pay a debt back, so I borrowed X amount of dollars. I can't pay the debt back. So, hey, guy, would you be willing to accept X amount of my shares in forgiveness of the debt? That's it. Okay. I may not be able to pay the debt back. Would you exchange my debt of what I owe you for preferred shares? You'll still be in a creditor's position. You'll still have them in a creditor's position. However, it's preferred shares. They're still a creditor, which means they basically have a better chance of still getting their money back if the company ever had to file bankruptcy or something of that nature. Owners of the company, equity owners, normally get wiped out or crammed down. Okay, that's how it works. I don't make the rules. So if you're an equity owner, you have the possibility of being crammed down and getting very little to none of your money back whatsoever. If you are a creditor, you have a strong possibility of getting most of your money back, if not all of your money. Now, you hear the difference. As a creditor, you have a strong possibility of getting most of your money back, if not all of your money back, as a creditor. As an equity owner, you have a possibility of getting little to none of your money back. So that's the difference of being the creditor and being an equity owner. Okay, and so you as CEOs and your management team need to understand that when you're going out raising money, you're going to have to give up something, guys. No, there's no fairy tales where, oh, wow, somebody's going to give you $1 billion for your great idea and your great dream. Not happening. Okay, not happening. All right. So let's be real. You got to be prepared to give up something, and you need to understand and give it a lot of thought and consideration of what it is that you would like to give up, okay, and why you want to give up that, and what it means to you and the company at the end of the day. As I always say, 100% of zero is zero. I'd rather have 20% or 30% of something than 100% of zero. So be prepared to give up something. And because once you give up something and you prove that it works, now you have a name and a reputation out there for being able to do the things that you said. And you also have a reputation of paying people back and your venture working out. So the next time you're able to not take the 30%, right, you may be able to get the 70%, the 80%, okay? But guys, don't think you're about to walk in anybody's door, whether it's a private equity, venture capital, angel investor, all right, and you're about to turn around and get to keep 80% of your company and give them as little as 20%. That's not going to happen. That's not even realistic. These people have worked hard to accumulate their money, or to get other monies from other people to invest in various deals, and they have to make sure they have a fiduciary responsibility to protect these people's money and even their own money to make sure it's going to come back with friends. That's the bottom line. That's the only reason people invest, is because they think that your idea has enough merit that it may work. and that you as a manager may be able to pull it off and execute it. Okay, so that's what everyone's looking for. That's how you get the money. If you don't have those things in place, hire competent people that can help you put those things in place, and go out and raise the money. Also, there are brokers out there that can help you raise the money and things of that nature, and they charge you anywhere from 10 to 20%, depending on how they actually do it, whether it's debt or equity finance. And if you don't like doing selling or pitching, or you're uncomfortable in talking in front of people, then you may want to utilize them. I would want to utilize them because a lot of times they already have a Rolodex. So they will take it to people that they have a good idea that they can raise the money. So rather than me going around trying to pitch it myself without a Rolodex and only my friends and family and friends, that's very limited, it's going to take longer. Now, a lot of people say this: do minorities have a disadvantage in raising capital? Absolutely. Minorities, the average discretion income for minorities, discretion cash, I should say, is roughly $5,000. So if $5,000 and I go to 10 people, that's only $50,000. Well, the average discretion cash for whites is $75,000. So if I go to 10 people that are white, my 10 white friends, well, that's $750,000. So it's a lot easier to take your business a lot further depending on who your friends and your network is, right? So if I had 10 friends that's black, I'm probably going to raise $50,000. That's not going to take my company too far. If I have 10 friends that are white, I'm going to raise $750,000. Do you understand why it's a little more difficult for blacks to actually raise capital? Not only that, there's other reasons outside of race and things like that. When we go to private equity, we normally don't know anyone there, so it's harder for them to relate to us and see us. So again, that's where representation may come in play, having somebody go that have a name that can represent you. All right, so you got to keep these things in mind. Whites have a lot easier time. It's not that it's fair or anything like that of raising capital, but you can balance out the playing field by hiring the right people to go do those jobs. Guys, that's all the time that we have currently, but I want to thank you for tuning in to Minority Business Access. Again, I want to thank you for tuning in to MBA, Minority Business Access. Thank you so much.
You've reached the end of another episode of the Minority Business Access podcast. Connect with us at solomonrcali.info to leave a review and access more resources. We hope you enjoyed this show and found great value. See you at the next episode.